and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts and independent advisor Vivek Mavani, Foram Parekh of Indiabulls Ventures, and Yogesh Mehta of Motilal Oswal join me on the show. Thank you to all of my guests for joining me on the show today. Today on Hot Money, we will discuss the frontline IT stocks which have corrected significantly, but yesterday did manage to have a little bit of bounce back. We discuss what's plaguing Coal India because that's somehow not been able to move as much as the other metal stocks have done. Allcargo Logistics has actually rallied close to 15% from the recent highs, from the recent lows. What's the way ahead? And we discuss MNC stocks because of late a lot of stocks, be it a Siemens or be it a Lind India or be it an ABB, all of them have rallied. So we ask a guest which is the stock in the MNC category that they like at this point of time. But let's first start with the IT stocks. Now, most of the IT stocks have fallen. In fact, yesterday both TCS as well as Tech Mahindra went below the 200 DMA. They managed to bounce back later. Infosys is below the 200 DMA. HCL is below the 200 DMA. What's the view on the IT stocks? Is the rupee changing direction a bit of a concern, or would you look at this opportunity to lap up some of these frontline IT stocks? So Vivek, I'll start with you. IT stocks, what should you do? And if someone has to take exposure, which is the best IT stock that they should buy in the frontline ones?
Okay. As far as the IT is concerned, I mean, I have on this program itself mentioned that my bet is always on frontline. So a TCS, Infosys and a Tech Mahindra in that order is my preference. And so even today, if I have to be positive and be recommending, I would still stick with TCS. And I think it's a very good long-term opportunity to accumulate on declines. That's number one. Number two, TCS, given its size, has displayed a sustainable and a consistent track record quarter after quarter, year after year of almost 20% growth rate and almost 90-95% of profit after tax, net profit translating into free cash flows also. Now this is very unique for TCS because both in terms of the size of the free cash flow, probably TCS has got the highest, but even as a percentage of profit after tax, probably at 90-95% TCS would probably be the among the highest in terms of conversion of profits into free cash flows, all of which almost 70% going back to investors in form of dividends and buybacks that they have done in the last few years. I continue to remain positive on TCS and the Indian IT overall, but TCS is the preferred bet. The point which you mentioned about currency, so if all of these companies have a very strong correlation to the rupee-dollar equation, given that much of their earnings are in dollars. Now, if we'll go back, that say between 2015 to 2017, rupee-dollar was in a range, so all of their earnings only in terms of dollars growth was reflected in the stock price. 2018, all of them saw very strong rallies, almost of 30-35%, because our rupee also moved from 64-65 levels to crossing 70 and almost 74 few weeks ago. A retracement back has also led to a correction in IT. So the point I'm trying to make is there is a very strong correlation, and so long as we believe in the longer term, INR will be a relatively weak currency where probably we could be going down on an average 2 to 4% depending upon the year or depending on the time of the year. There's a seasonality also. A 2 to 4% rupee depreciation can be assumed. So this little pullback in INR resulting in almost 18-20% stock price correction for TCS or in Infosys or others also, I think is a buying opportunity.
Okay, Yogesh, what about you? What are you all telling clients? Obviously, you must have been getting queries regarding the drop that we've seen in IT stocks. Are you telling them to start accumulating? And if yes, which are the stocks that you're telling them?
We do like IT sector, not only because right now the correction has happened only because of the traditional thoughts that if currency is depreciating, rupee is depreciating against dollar, then it is weaker for their margin purpose. But as per the analysis, it is hardly matter of hardly 1 percentage point that to in for that particular quarter, not for every quarter. We have seen in history, like he mentioned, in 2015, 16, 17. So this time again, there is no difference. But what we believe is that digital is doing exclusively well over US, and now BFSI is also doing very well. This time on the quarterly side, TCS was a bit of disappointment, but rest all, Wipro, Infosys, TechM, all have done very well. So we have all three buys. We have Infosys and TechM, both are on the buy side. Wipro is a neutral one. What we believe is that 5G will add some more earning trajectory for TechM. Even enterprise and communication will grow by 8 to 10%. This is management commentary. What we believe is 2 to 6% growth rate in a constant currency will add up, and 12 and 13 times P multiple for Tech Mahindra. That provides a very huge opportunity for investors at current point in time in this correction. I think it has hardly corrected from 740 odd level to now 690, 700 level. So again, our target is 800 rupees based on FY20 earnings. So we believe that it will provide a better opportunity to have it into the portfolio.
So your top pick is Tech Mahindra, but on the other IT stocks frontline, what's the rating that you all have?
Infosys, we have a buy rating, and that is again on the large cap side. Infosys is the preferred one, and Tech Mahindra is on the mid.
And what about TCS and Wipro?
TCS on the valuation concern, we have a neutral rating, and Wipro again with the growth this quarter was good, but then also we have maintained neutral rating at this point in time.
HCL Tech, do you all cover?
HCL Tech again is a neutral.
Okay, so Tech Mahindra and Infosys is something that you all are recommending clients to buy this one. Foram, what about you all? What are you all telling your clients about IT stocks?
So we are telling them to book profit currently, because we have seen steep upside in the entire IT pack, and now the prima facie reason being rupee appreciation, and we think that rupee appreciation is dead on the card still, because of course crude has slipped below $60 per barrel, and we are expecting good Q2 GDP data also to be there, and we feel that the sentiments are positive for the emerging markets, and that is why now we don't see rupee depreciating to 72, 73 levels again. Of course, many IT companies must have hedged their positions, but then we also see that Q3 is a seasonally weak quarter for them because of festive season. So the billing would be affected, and again the utilization rates would be affected. The large deal wins would be affected. So when we know there's a seasonally weak quarter coming, we do not want to go and buy at current premium valuations. We see that more 5 to 10% correction is due in the entire IT stocks, and once they correct to 5 to 10% from here on, we like TCS and Infosys. Of course, both the companies have good digital revenue coming, as a percentage of total sales, and TCS has been growing at a good 20%, and the second is Infosys, which is growing at 13-14%. So both are reasonably valued, and we feel that one would get it at a discounted rate, or there is no hurry to go and buy at current levels.
Okay, Yogesh, in your models and all, what have you factored in for the rupee? Do you see more depreciation for the rupee? Is that thing that you're looking at?
On an average for third quarter and the second quarter, we have incorporated 71.5, 71.80 as a rupee dollar parity, and we don't foresee that it will appreciate much below 70 level at the current scenario juncture.
Okay, so that's the view that's coming in on the IT stock. I think but Tech Mahindra, TCS, Infosys are the stocks that are actively spoken about at this point of time. The next one is Coal India. Let's pull that up, what it is doing. Today it's managed to inch up slightly because of the Morgan Stanley upgrade, but nevertheless the metal sector of late has seen a lot of selling. Coal India somehow over the past few years has not participated much. There are issues of its own, but what are these issues and what's the long-term outlook going ahead? Yogesh, what are you recommending your clients on Coal India?
See, Coal India as a Maharatna company and the world's largest producer on the coal side, but that is good on their creditability on the paper. On real terms, it is we can say that Lagarde issues are higher manpower cost and other benefits they are passing on to the employees. This quarter it was around 9,000 crore they have provided for that staff cost. So overall on the annual basis, 36,000 crores. Though it is a net cash company, dividend yield is the one which is very fascinating and catchy to the eyes of investor, 5.5%. But even if you accumulate since listing, find 20 rupees, 22 rupees dividend every year, then also you are not earning any money out of that in your investment. So that is the biggest laggard. Secondly, a higher share of their supply is going to the low remuneration type of power companies. So that is not fetching much of a profitability. With the 85 million ton of FSA and the e-auction, so it is, we believe that that is only a catchy one which is generating profit. The rest all is not generating any profits. So prima facie 5 times EV to EBITDA is a good company, but valuation multiple we cannot keep it much higher, that it will trade at 8 times EV to EBITDA or so. So that is not much of a discount rate. So we believe that though it's a buy, but again the biggest hangover is OFS by the government of India. Stake sale. It has done multiple times, and still this time also it has done. They have done.
Okay, Foram, what are you all recommending clients on Coal India? Are you all foreseeing any fundamental issues in the company?
No, there are no such fundamental issues, but the only thing is being a PSU, we are telling our clients to stay away from all the PSUs, be it in the banking sector or the metal space, anywhere. So now we have seen that there was a disinvestment news also in Coal India, and again, the fact that we have a central elections also coming in and all. So PSUs would be like, like a big laggard. And we personally feel, as a house view, that there is a cannibalization in the market share from PSUs to private sectors, and that's what has witnessed in the banking sector, So we feel that let it be like an avoid, because it's not going to generate more alpha to the portfolio. And if we look at the company, of course the company is doing very good. Profit has been coming nice at a very good pace, and production is increasing by good 10%. But then again, sustainability is an issue. Would this kind of performance sustain in the future? So when at this current juncture where we have seen such steep correction and we have good stocks available at attractive valuations, we do not want to skew towards PSUs.
Okay, what about you, Vivek? You agree that one should stay away from PSUs or probably Coal India and look for better opportunities, or would you take this opportunity to accumulate?
Well, I'll put it this way. In terms of from the time that it has got listed in 2010, November of 2010, the stock has been in the range of 250 on the lower side and 450 on the higher side, and that is seems to be like a definite range. Stock prices in the long term mimic the growth in profits, but the trouble with Coal India is there's no really trend of growth in profits that you can really make out. So in 8 years or 9 years that it has been in the public domain, what we have is that profit before tax has been in the range of 10,000 crores to 14,000 crores. So some years it's been increasing, falling, but that's been the range, and the stock has also been in a range. What you have is in the last 2 years, 17 and 18, is that profits actually fell to 9,000 crores and 7,000 crores respectively. So a company which doesn't really have a clear trend of profits is going to have a similar trend as far as stock price also. Range bound profits, range bound stock price. So tactically, I'm not really averse to being in Coal India, but purely from a trading point of view, now that the trading ranges are very well established over the long term. So you say buying at less than 300 levels, 250, 300 level range in terms of buying on declines, and selling in the range of 300 to 350, or maybe if you're lucky even 400, and you get those opportunities at least once a year. In between, you have a 5-6% dividend yield, which probably takes care of your cost of holding, in the sense that if the money was in the bank, maybe on declines I can buy Coal India and wait for a few months and hope to sell it 20% higher within that same trading range, hoping that maybe there'll be one out of 4 or 5 good quarters. Otherwise, to come back to your core question, what is plaguing Coal India? Well, there are 2 things. Difficulty in ramping up mining and production of coal itself, number 1. The coal production from Coal India is not even growing in high single digits, probably low single digits is the growth, if at all there has been growth every year, number 1. Number 2, typical of any old PSU, labor issues are a given. It's assumed that it has labor issues. Yogesh mentioned about the kind of provisioning that they have had to do, and I'm not even hoping or fantasizing that those issues will go away. But as tactically, as I mentioned, from a trading play, I don't mind buying roughly at maybe 250 with the clear intent that more than 300 I'm going to be a seller also. I'm only playing for that range to get my 15, 20 or 25% with a 5-6% dividend yield built in.
Okay, so that's the view that's coming in on Coal India, but two of our guests say they're not the right time to buy. But Vivek has a different view. Basically, it's more of a trading view, not more of a fundamental long-term pick is something that he's talking about. The next stock is Allcargo Logistics. I don't know what the counter is doing. Let's pull up what the counter is doing today. It's absolutely flat in trade, but from the recent lows, it's rallied close to 15%. Was doing well in trade yesterday, but nevertheless, on a 12-month basis, 9-month basis, is down anywhere between 35 to 40%. Will the rally continue from the 15% low? What's the view going ahead? We'll ask our guest. Foram, I'll start with you. You have a view on Allcargo Logistics?
Yeah, so Allcargo, the kind of correction we have seen in the stock, we feel that it's trading at quite attractive valuations, and the entire logistics sector, we feel that should be held for a long-term perspective rather than for a trading perspective. And if we look at Allcargo segment, we have a good volume growth of 20-22%, on every segment, and one of its loss-making business is also cutting down on its losses and trying to revamp and come back, in profitability by ways of increasing its utilization rate. So we feel that it should be purely from an investment perspective. Also, there are a lot of developments happening, which would benefit the logistics sector. We're seeing a lot of sea-bound, kind of routes opening up, and which would be again beneficial for the logistics sector. And the biggest overhang, the US-China trade wars, if that has to continue, then India would be like a beneficiary out of that in terms of exports. As a result, logistics sector would directly benefit out of this. And as a result, we feel that everything stands tall for this company. Valuation-wise, it's trading at hardly 10 to 13 times P on an FY20 basis. And sector is having a good demand. We just saw the festive season, which would again witness good quarter for the entire logistic, sector. So on and all, everything is good. So we feel that one must definitely have this stock as an investment theme.
Okay, what about you, Vivek? Any view on Allcargo Logistics?
I don't track Allcargo, so I'll reserve my comments at this point of time.
Okay, so that's the view. And Yogesh, I believe you all came out with the note. You all met the management. What are your views after meeting the management?
See, the views are such that though we were very gun-go about that around 190 and 200 rupees last year, but then result started fading off, and we could not find any much value into that. So as the valuation 10-12 times, like Foram mentioned, it is quoting at 11-12 times right now, and forward earnings, we don't foresee that more than 15-17% CAGR growth rate would be there over FY19 and 20. Though volume growth is 22% and globally US is also doing well for them, but CFS and MTO both are growing, yet power they are increasing from 30 gigawatt more, so it will be total capacity of 60 gigawatts by FY21. But I would say that after 15% rise in recent post results, so it will not give you a faster returns in terms of 6 months or 12 months, but you will have to have a longer term view, like Foram mentioned. Then FY20 base, if you hold on around 100 rupees, you will get 140, 150 rupees probably, if the result, the delivered results are more or less in line with expectations.
So what did the management tell you? I believe you all met the management. Did they give any kind of positive commentary? Did they give any guidance? Did they give any outlook?
They given the guidance of 15% growth rate in MTO and CFS segment both together, and about this adding up power capacity, and they have closed down that Kheda ICD and Kolkata operation is also now subdued. So that is what they have given a guidance, but not much spoken about the clarity about what will be for FY20 onwards. So they have given just a projection and the capex guidance, nothing apart from that.
And what's the risk that someone takes if they are taking position?
Risk would be, again, since it is in as trade war happens and there is a slowdown in US, as everybody is anticipating right now that the US is going to slow down, then it will be a much more impact on the freight cost rate. Then that will be directly flowing into the bottom line. It will hit there. Okay,
and Foram, do you all cover any of the logistics stocks? Do you all have them under coverage as such?
No, we do not have.
Okay, so that's the view that's coming in on Allcargo Logistics. More of a long-term play is something that our guests are speaking about. And the final stock that we want to go about is the MNC stocks. Now, a lot of MNC stocks have started rallying. We have a whole host of MNC MNC stocks here, but which is the best play among, if you want to look at a long-term perspective, which is the best MNC stock that you should take exposure to? We'll start with you, Vivek. MNC stocks, do you like any of the MNC stocks as such?
See, firstly, I do like few MNCs, but generally when we do stock picking from the portfolio point of view, most investors will be averse to the ownership, whether it's owned by a foreign, whether the ownership is foreign corporation or an Indian promoter, so long as a company delivers growth, delivers cash flows and generates high return on equity, return on capital. So that's, one is really indifferent, or at least I can speak for myself that I'm really indifferent so long as there are no corporate governance or ethical issues or balance sheet issues, assuming those things being equal. But nevertheless, since the program is about MNCs, then I'm positive on the paper cycle, and International Paper APPM is is the stock that, or the company that I'm positive over. The stock has so far done very well given the cyclical uptrend in paper. Just to give you a perspective, this used to be once upon a time called Andhra Pradesh Paper Mills, which was acquired by International Paper of USA sometime in 2011-12. And subsequently, there has been restructuring and cleaning up of the operations. So from a loss-making company, it has not only turned around, generates very healthy cash flows that in the last 4 years, deleveraging of the balance sheet, they have reduced debt from peak of almost close to 500 crores to now just about 200 or less than 200 crores. So almost 350, 380 crores of debt has been repaid. Return on capital, return on equity, which were negative, as I mentioned, used to be loss-making company a few years ago. Today you have return on capital, return on equity at upwards of 20% with very healthy cash generation. Even now, on a trailing 12-month basis, it's trading at about 7 times EV by EBITDA. Since it's a commodity company, I'm looking at EV by EBITDA, or maybe about 12-13 times earnings on the current year basis. Forward is just about 5 times EV by EBITDA and maybe 7-8 times earnings. Also, given the fact that yes, there is a cyclical upturn in paper globally, has also helped in this healthy performance. But at least for the next 1 or 2 years, paper cycle is likely to stay robust. So international paper is something that something that I'm positive and bullish on. A disclaimer that we already have an exposure on behalf of our clients.
Okay, what about you, Yogesh? Among the stocks that you all have, which is the MNC stock that you all like?
We have a few stocks in different sectors, like P&G, Nestle, all are under coverage. Even ABB and Sanofi in the pharma. GSK is also there, but I will speak about Sanofi right now because we have a buy rating. Restall, we have a neutral rating because of the higher P multiple and all. Now, this company is present everywhere in chronic segment, wherein anti-diabetic, Lentus is there. Even Allegra, everybody has heard about the other name is Combiflam. So all these are doing very well, and this time the quarterly numbers when it came, it's a December ending company. So third quarter number which has come, that has shown a traction of at least 17-18% growth rate in the profitability. Payout ratio is always high in MNC companies at around 40-50%, and in some cases it is 70%. So that is added advantage into that, and we believe that sales has given uptick, and that will drive the growth over next 2 years, FY19 and 20, about 17 to 19%. So parentage of foreign parentage, domestic advantage because new innovative product will come via parent company, so that will be added advantage to them, and quoting at 31 times P multiple at current price of 6,000 around. So we have a price target of 6,850 at post third quarter numbers, the CY18. So we have a buy rating on that, but rest we have coverage on Nestle, P&G as I mentioned, and GSK also, but all are on a neutral rating.
So my only question on Sanofi is that most of the MNCs this time around, last few quarters they've been doing well because they had the base of GST, which actually showed that growth coming. This quarter around, the growth wasn't much because the base is also much higher. Will growth be subdued over the next few quarters?
If we compare YOY, then the growth was 11.5 to 11.7%. So we believe that with the new launches and the innovative products which will be there from the parentage, that will drive growth further by 12-15% over next year, and then 17% over FY20.
Okay, so that's a positive view that's coming in on Sanofi. And Foram, among the MNC stocks, which one do you like?
So we like Bata India, and we are very bullish on the entire consumption theme. We are seeing good pickup in the rural income, and again, you know, with the crude coming so lower, we feel the direct sector which would benefit would be the consumption sector. So the best MNC to pick from the sector is Bata India, and Bata India, as we see, it's going like a good, you know, revamp in its strategy, in its product portfolio, and the clients that they are targeting. They're targeting to now almost all the age groups, be it the, you know, school children or the teenagers, you know, and they're also having good all kind of price sensitive products on their shelf. We see the lower end of the products also, as well as the premium category also over there. So I think the company is doing the right thing by catering to all the product segments, to all the age groups. So this would be there for a long time, and company is taking conscious efforts to, you know, increase its ad sales and have a good brand ambassadors and everything to show good visibility. Companies also opening up in tier 2 and tier 3 cities. So I feel all in all it's a very good stock. The fact that stock has come down to a good valuations right now, after like 10% correction or so, I think it augurs a very good buy, because volume growth has been consistent at 20-25%, and again we feel that it's there on the cards. So we do not see any negative in the sector or in the stock. So we would like to go.
Do you have active coverage on Bata?
Yeah, we have been recommending Bata since a very long time, and we feel that it can still go till 1200 levels, because again we had a good festive season also, which would be catering in the Q3 results. So all in all, we think it's a very good stock and one can buy at current levels.
Okay, so those are the stocks that's been spoken about as far as the MNC stocks are concerned. But with that, it's a wrap on today's Hot Money. Vivek, thank you so much for coming in. Yogesh, Foram, thank you so much for coming in today. Ask BQ comes up next. Stay tuned to Bloomberg Quint.